Most turnkey real estate investors, they skip the steps that actually protect their money. I'm going to talk over the next 15 minutes about a checklist that could save you a lot of time, headache, disaster, and actually put money in your pocket, not only today, but in many years to come. So the hidden fact or hidden stat that no one looks at: older fixer-uppers can lose you a lot of money. Now, I've done thousands of those before. I still own them, but I know that my maintenance, repairs, the surprises, they're going to be a lot more substantial than new construction. So depending on your risk level, I'm always asking people, the first checklist, is it an older home or is it new construction? This is a totally different underwriting approach that I was not taught 26 years ago when I first went into real estate, and it makes a huge difference. If you are investing from afar, then I would highly recommend that you look at the difference between the performances of old fixer-uppers versus new construction. There's a reason why I hung up my rehab shoes 12 years ago to not do those types of deals with my investment partners. Why? Because there were too many surprises. And with my own money, that's fine. I do the work on my own. But for investors who are busy with their own career, their own businesses, they're just looking to have a rental real estate portfolio on the side, old fixer-uppers can be very time-intensive, lots of surprises. So I tell people the first checklist: is it new construction? Is it an older fixer-upper? Both of them can make you money. One of them has a lot more exposure to surprises, headaches, losses, more turnover, tenant turnover, compared to new construction. Again, I've been doing this for about 26 years, the last 10 years in new construction, and comparing thousands of each property. The new construction is going to keep you a lot more balanced and a lot easier for you to manage from afar and get the results you're looking for. Okay, step number one, you got to look at that easy checkbox. Is this an old fixer-upper or is it a new construction property? I didn't know how important this was. And again, I've been doing this 26 years. It wasn't until the last decade I saw that there is a monstrous difference in performance, in turnover, in maintenance and repairs between the old fixer-uppers that I was just naturally inclined to do. That's what got me my start many years ago in Central California, fixing up old houses to rent them out, to resell them to first-time home buyers. But the market has really changed, and it seemed like I never really quite did my numbers to see how much those were costing me. And again, I didn't have a comparison because I didn't start doing new construction until about a decade ago. That's what got us into build to rent, building properties specifically to rent them. Obviously, that's becoming all the buzz now. It's kind of turnkey real estate 2.0. And it's not just a buzz for no reason. It's because the fundamentals work better. For me personally, doing thousands of old fixer-uppers and thousands of new construction now, I can tell you that my tenants stay around about 3 times longer in new construction homes than older homes. That's tremendous. Also, my maintenance and repairs, there have been much less in the surprise department. Now, surprises in real estate, rental real estate, are usually never good things. These are, especially with the old fixer-uppers, a roof you weren't expecting, a sewer main break. If you're investing from afar, these can absolutely break you, not just with the cost, but also the coordination, unless you have a really good property manager. And even then, it can drag you into things that you don't want to get dragged into. So the first step I tell people to protect their money is to ask that simple question: is this an old fixer-upper? Is it a new construction property? I am very unemotional with this now, but the new construction properties perform better with less headaches and a better growth pattern. You don't want to be ready to wave the white flag because an old fixer-upper has just sucked your time, your money, your efforts dry instead of growing. New construction, I've seen the opposite results, which is why I focus on it. So step number one, is it a new construction? Is it an old fixer-upper? Both can work. One will have a way higher degree of risk. One will have a better trajectory and fundamental purpose and performance. Okay, step number 2, location, location, location. So we all hear about, oh, you got to be in the right location for the rental real estate you're going to own. Of course, but that kind of leaves you high and dry for what actually constitutes a good submarket or location to be owning real estate in and renting properties to tenants. There are 5 questions that I always ask before I even will look at the performa. Because if these five things are not occurring in the background or the forefront, I don't want to invest there. It's just something that I've learned, something that's helped me build the most amount of wealth in my career, owning real estate in the right areas that have not only good cash flow, but good equity growth. I like both of those. And that is key with finding out, asking those questions of what constitutes that good location. So the first question I always ask, is there economic growth occurring there? What does the job source look like? Are there jobs being added to that location and submarket, or are they actually depleting? Man, this is huge because jobs allow you to be able to pay rent. That's what helps create better tenant demand. So I always ask, is there economic growth in the submarket I'm looking to invest in? Second one, is there population growth? This is so key. I mean, something that you just cannot discount, because if you're not having population growth, and yes, certain areas in the US are actually depleting in population, that's a really scary thing. So I don't want to go where there's depletion in population, where there's no job growth happening, where it might be a one institution town. If you've ever heard that saying, that's economic growth question. If it's built off of one type of business, one main employer, I don't really want to invest there, because that kind of scares me that if they pack up and go home, go someplace else, tenant demand drops, and obviously population drops tremendously because they got to go find someplace else to get a job. Number three is affordability. Is it affordable? Does the average salary afford them to be able to rent the homes that we're building? And if the answer is no, man, I don't want to invest there. So affordability is absolutely key. And that ties in with desirability. Do people want to live in the area? What's the draws to the area? Are there any amenities? And for the tenant side of things as a landlord, desirability for me is it landlord friendly? I'm not investing in a state or a submarket within a state where the landlord laws are against the landlord. That makes no sense to me. I've done that. Areas like, for example, inside main Atlanta, there were some areas that were extremely landlord unfriendly through the pandemic. It took me 16 months to move out certain tenants, and that's just not fair. So that we're asking the question, is there economic growth? Is there population growth? Is the affordability good? Is the desirability good? And finally, is there healthy supply and demand in that area? So obviously, I don't want to go to an area that's overbuilt with houses. I want to go to an area that's underbuilt with houses. So I always ask the supply and demand question. Is there a shortage on the type of housing that I'm wanting to build there and rent there in that area? You ask those five questions, that is a huge steering to make sure you make money instead of lose money. Okay, step number three. This is known as the real rent test. Now, how do you make sure that rents are for real in an area? The first question that you should always be asking, which almost seems too obvious, is this new construction rental rented yet? This is one of the best ways, now with certain things that people are building, things are still filling very quickly. You could be stepping into a new construction property with a qualified tenant already in place. That's the best rental test that I know of, is to say, what is the property renting for today? Is someone in there, and what are they paying? You can also see their payment history. This is the best way, I think, to verify real rental comps. Is it rented to a qualified tenant? Have they been paying on time? And that pretty much answers the question. If the property is not rented, then you want to be asking about average days on market and also the 3 comp rule, which just means, okay, we're asking $1,350 for this duplex in Palm Coast. Let's see, are there other properties that have rented or available in the area that show this available rent? Again, so if you're looking to comp that and then all of a sudden you're showing, well, wow, most of the comps are showing $200 higher than what we're asking, that's a great thing. If you're saying, ooh, gosh, we're actually asking $400 more than anyone else or anything else on the market, and it's been sitting on the market for 127 days, that's going to give you some red flags. So the real rental test really comes down to asking that question up front. Is the property already rented to a qualified tenant? True turnkey real estate can provide that qualified tenant already in place, so you're cash flowing day one. find out the rents, find out how they've been paying. If the property's vacant, that's okay as well. Just make sure that you check for some other comps in the area. And is the rent that you're asking a fair rent compared to what's around? And hopefully there's not too much on the market. So, real rental test, find out if there's a tenant there. Also ask, what are some comps around the area? Am I matching it? Am I high? Am I low? That'll give you guidance to know whether you should be having a green flag, a green light to buy the property or not. Step number 4, the 5-minute pro forma review. If you're not looking at a pro forma of some key numbers to buy a piece of rental real estate, you're just gambling. You are not investing. You have to be able to look at a pro forma and go through it on a couple of key bases. Now, these can get pretty sophisticated, but again, if you understand just at least certain numbers, it can be a guidepost to head you in the right direction or avoid going in the wrong direction. Absolutely key. There's really only a few numbers that matter. Turnkey real estate, true turnkey real estate. And especially with the new construction, this is going to be a key factor, not a complete solvent, but a key factor for how you look at your pro forma. One of the biggest things that you can look at in the pro forma is purchase price for the property. I mean, I know that sounds like a very oversimplified thing, but if you're not looking at the purchase price to see what buy-in is, you need to see. We have a lot of people coming from California investing here in Florida because the average single-family home in California might be mid 500s, where you can still get a starter home here for under 300,000. That is a major starting point to know if a property will cash flow or not. What you're buying it for, how much you need to put down, so what your investment is going to be between the down payment and your closing costs. You'll want to look at that. You'll also want to look at what's your monthly payment going to be. Monthly payment is really important. Now, what I've seen here in Florida especially is monthly payment can really be skewed by the interest rate on your mortgage loan and the insurance. This is something you got to look for in Florida. Another reason why, you remember my question, is it new construction, is an old fixer-upper? The old fixer-uppers, a lot of the times now, you cannot get the low interest rates that a builder can. Certain builders can get something called a builder forward commitment, where they're actually buying down the rate for you, sometimes 3% lower than what other banks are offering. So that lower interest rate will help you get a higher cash flow, because now your buy-in on the property is lower, your interest rate is lower, which makes your mortgage payment lower. And with new construction, we're seeing a lot of insurance companies give favoritism to them. So sometimes you can be paying 1/5 of what an old fixer-upper is in insurance costs for full coverage. All that goes to your bottom line. When you have that lower interest rate, you have that lower insurance payment, and you're taking that from the rents, what's the average rent going for? Then you're going to see what your true cash flow is. Another number that's important to look at on the pro forma is, what is the interest rate locked in for? How long? I do not ever suggest to people to lock into an interest rate that's only 18 months, 2 years, 3 years. I think that's too short. I like to look at a minimum of 10 years, because you could be looking at that pro forma and saying, oh, things look great for the next 2 years. Well, 2 years comes really quick. And all of a sudden, if interest rates are still going up or higher, you could be in a situation. Sure, if they go lower, you're in a great situation, but I like to hedge my risk. I want to lock in at a longer term interest rate that gets me cash flow today and gives me visibility for a longer term, so I'm not forced to make any sort of crazy decisions. Those red flags are going to pop up if you start looking at too high of a purchase price where the buy-in doesn't make sense. So that means the rents won't seem to cover. Also, if you're buying an old fixer-upper, a lot of times those mortgage costs are going to be higher because the interest rate's higher. You can't get those builder forward commitment lower rates. And also, your insurance can be sometimes 4 or 5 times more. Even if the property is more inexpensive, all of those things can be eaten up. And at the end of the day, what you want to see on that pro forma is, will there be a monthly cash flow at the end of all costs going out? And is there growth patterns for that area? And what will the value of that property be conservatively worth in 3, 5, 7, 10 years? I always look long term with my rentals now. And if you look at that longer pro forma, when you're doing a long term buy and hold, it's just that. If you're not looking what the growth patterns have been for the last 50, 100 years in that area and doing those conservative approaches for the growth of your property, well, then you're not really buying into the whole strategy of long-term buy and hold rental real estate. You got to look at all those numbers. And by looking at all these numbers, it's going to be able to take away the noise and paint for you that picture of yes, go or no, stay away. Step number 5, holding strength. This is the closing filter. If rents drop 10%, am I going to be okay? If values drop 10%, am I going to be okay? Are there large chances of maintenance and repairs on this property in the next 3 to 5 years, or is there not? These are the things that can really give you a leg up or strike you down. If you don't look at some contingency for maintenance, repairs, rents dropping, then you don't have holding power. You can get forced to sell in a sideways market. I've had properties now for over 20 years where there were cycles in the market. And when I held them and could drop rents a little and not be forced to sell, those short-term blips in lower rents and lower values, they didn't do anything to me. I could rent through it. You want to have holding power. So you want to be able to say, look, if rents drop 5, 10%, am I going to be okay? Am I going to be stuck with a property where there's tons of maintenance and repairs when I can't sell it or sell at a huge loss? You got to lean in on these things and find out, will the property still work? Do a little bit of contingency looking on the downside. A lot of the times, again, we do this checkbox. Yep, it's going to go up every year and do this much more. That's great. I've seen that happen lots of years that I've owned real estate, but not every year. So do that closing filter. Find out, will the property still work if you've got to hold through a few years of sideways markets or rents being dropped? This is realistic investing. And if you're able to have the emotional intelligence to stay calm through these, well, then you can ride the next upcycle. I've done that twice now in my real estate career of 26 years, and it's something you have to be prepared for. Can you hold? Is there holding power to the property you're looking to buy? So overall, you want to look at your checklist. You're going to ask yourself the questions about, is it new construction? Is it an old fixer-upper? The fundamentals for the area. Everyone tells you location. I went over the top 5 questions that I always ask to find out, is it a good location or not, because there are underlying things that will help determine that. Also, the rental check. You're going to check the rents. Is it actually rented? And also, are there 3 rental comps supporting what it's supposed to rent for? If it's not, these are things that so many investors don't even look at that can save them time and headache, and also put them on the track to make money instead of lose money. And that comes down to the pro forma, as we talked about. Sometimes we get scared to look at pro formas. They're overwhelming. We can't understand what's important. And there are a couple of key numbers to look at. What's your buy-in price? What's the actual rent? What's the monthly cash flow after all expenses? What's going to affect that a lot is what's your insurance payment going to be, especially in Florida markets. There's better pricing on certain properties like new construction over old fixer-uppers for a number of reasons I've gone through in other videos. And what's your interest rate? I hear so many people saying, I wish I had the interest rates of 2021. Well, you still can with certain builders and builder forward commitments. And as you know, for buying on properties, if you're looking long-term, well, then you want to be able to have the cash flow work today, because if it work today, the odds say historically, then moving forward, you can be able to build that cash flow even more and build equity even more, especially if you answer those 5 questions of location, location, location. So go back, look at this video again. And if you're overwhelmed with how to understand those 5 location factors, if you're having trouble understanding a pro forma, just click the video below and also write to us and see if one of our property counselors can sit down with you to overcome this fear. Because once you understand those certain numbers and what to look for and go through this checklist, you can start to build your rental portfolio with more confidence. So take that into account, reach out to us, click the like button below. I am going to be going further into these things so that you can follow us into the market live to see properties that actually have this checklist down and what we can do to help you.